Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, and with me is Chase Wilsey here every Saturday talking about your money, the economy, investing, all these important things to help you grow your net worth. With that, let's get started. Good morning, Chase. How you doing this morning?
Hey there, doing well.
Well, good. We got a lot to talk about. Crazy week this past week in the market here.
Yeah, and I think you're still, I said it last week, I think you're still in for, well, actually I said I think May's going to be a rough month, and you corrected me that we're still in April, and I was like, yeah, I guess you're right, and the craziness has continued, and I don't think it's going anywhere. I don't think there's anything that's going to necessarily turn things around here in the short term. We know that historically the summer times are difficult months in terms of volatility. I just got to say, be ready for it.
Yeah, and the S&P 500 is in correction territory. I believe the NASDAQ's in bear territory, down more than 20%.
It's down 22% year to date. I'm guessing, gosh, I'm guessing from its high close to 25% is what it's down.
Yeah, from its high, probably more than that. We're talking year to date. So, and what's actually happened is the big tech companies are starting to struggle. I'm quite excited to see many big tech companies start to struggle. I have been hesitant on the group the past few years as the valuations just did not fit into a value investor strategy. Many people confuse my dislikes for stocks as dislikes for businesses. In fact, I do believe many of these companies are run tremendously with sound balance sheets, good margins, and good products. It has just been the high valuations that just keep me away from it. And companies we can talk about, we include the Alphabet. Google.
Yeah, Alphabet. So I'm still not used to that, but
I know. I still want to say Google, Facebook. I know.
But Alphabet did have I'm going to call it a pretty bad earnings miss this past week. And I was curious where the valuations now stood for the stock. The company had a bad quarter. Its earnings per share of $24.62 missed the estimate of $25.91. Revenue of $68.01 billion missed the estimate of $68.11 billion. And also, too, YouTube, which has been a big kind of growth story, and I'm going to call it a darling for the stock. Their advertising revenue of $6.87 billion missed the estimate of $7.51 billion. That's a pretty big miss there. The stock now trades at a forward PE of around 17.2 times next year's earnings. Again, we saw it at 16.6, so it's still a little bit overvalued, but you're starting to see valuations that are getting attractive for some of these big tech companies. As I said, this is still a little bit high, but I wouldn't be surprised to start finding value in some of these big tech companies. The market is likely to remain volatile, as I said.
And I was shocked by the YouTube number. I mean, that's what, a decline of 800 million, I guess, is about.
Well, not a decline. That was the estimate.
Oh, the estimate. Okay, yeah. So they missed the estimate by 800 million.
There's still growth in the company.
Still growing it, but
when you trade at high valuations, you gotta keep growing. Even if you're going at a few percent, the market doesn't like that if you trade at over 20 times earnings, unless you're Apple. But
right. Well, and actually, it was not a decline, as you said. It was missing the estimate. But who actually did have a decline, their first loss in 6 or 7 years was Amazon.
Yeah.
First losing quarter. I think it's 7 years, I believe I saw.
And there was some, I'm going to call it funny business with the numbers.
Yeah.
They didn't have an actual major loss. It was because of the Rivian stake.
Oh, yeah.
Well, and they had remember they had a record profit last quarter because they had a huge markup on their Rivian investment. And this quarter they had a huge loss. I think Rivian's down like 70% year to date. So they had to mark that down. So that's what made their earnings look quite disastrous.
Right.
They still weren't great, but the Rivian stake made things look really bad.
Yeah, and the accounting is called mark to market. You got to mark it too. So if things go up, it's pretty good. Now, sometimes it used to be what was it, the cost or mark to market. There was something there. So you only got hit. You never got the benefit. It seems now they got the benefit, but then you also have to take the downside. And Rivian, I think it was a high of 133. I think I saw it like in the 30s this past week. I'm not sure where it is now. but just again, that the hype of the market is being pulled out, and these hype companies, we can also maybe somebody call them about Teladoc, another one. I think one day they're down 50%. They're down, 70, 80% from their high. The realities are starting to come back into investing, which I'm glad to see. I'm glad to see you don't hear or see anything more about meme stocks.
Yeah.
That is in Reddit and all that seems to be, and they thought, see, we're beating the big guys. Like, no, not going to last. Didn't last.
Yeah, didn't last. And I did want to mention one thing on big tech. We're not supposed to talk about it today. It's not on our list, but I just got to bring it up because it bothers me with Apple. It's so funny. I mean, they were down a little bit yesterday, but at first they were up after the earnings report. And they beat on sales. They beat on earnings. But it's just so funny how much people love Apple stock. The terminology is like, Apple's revenue pops 9%. It's like, if you talk about, I'm just going to pull out AT&T. AT&T, sales growth of 9%. That's okay.
Right.
Apple pop? What is that?
Because Apple's what, 7%?
9%.
9%. So they had the same growth.
I don't know if AT&T was up 9%. I'm just kind of comparing, if it was an AT&T type like business, and AT&T is looking for like mid to high single digit growth on the sales. Well, you look at Apple, they're looking at growing 8% this year on sales, 5% next year, and 4% the following year.
Right.
That's about what AT&T is looking at. But Apple trades at over 25 times next year's earnings. It's just, I'm sorry. It's just, you got to be careful. And if Apple stumbles a little bit, I think you can see that stock fall, and they make up about 7% of the S&P 500. That's going to bring down the index even more.
And again, you make a good point that these are growth companies. And again, we don't hate the companies. We just don't like what people are paying for them because we've seen this story play out before many, many times. And we actually show people over the long term what growth does versus value. Value does outperform growth longer term. So that's what we are concerned that people are going to lose a lot of money because they fall in love with these. And I love Apple. And I love my Apple phone. I mean, it works great. I have an iPad, works great. So I like the products, but I don't like paying, what did you say? The
25 times.
25 times. The average over the last 100 years is 14 to 17. If you have that high growth, sure, you're going to have a higher valuation, but that growth appears to be slowing down. And what are they going to do for an encore? And no company stays at the top of the mountain forever. And I think their time may have come. I think it probably came about 2 years ago, but they've done a great job coming out with new things and keeping those stock high, but it's not going to last forever.
Yeah, and as you said, if they were growing so at like 15, 20%, yeah, a company like that can trade at 30 times earnings. It's not something we invest in because that's that growth philosophy. Right. But I understand if a company is growing consistently at 15, 20 times each year, well, that makes sense to kind of have a higher multiple than the historical average. But 5% growth, that doesn't warrant a higher multiple.
Right. And what will happen, eventually the growth investors will start leaving. And unfortunately, the little guy is going to be left holding the bag. Well, yeah, but I love Apple. What's going on? Why is it not going up? And it's because of things they just don't understand. And again, it doesn't happen in 2 or 3 weeks. This has been going on for years, and it appears to be we're at the end of the boom cycle for Apple and the growth cycle for Apple, where it can justify or have those high valuations. And the other thing we talk about too is that maybe it doesn't have a drop down 100, but maybe for the next 5 years it trades between, we'll call it 140 to 170, and you make no money on Apple for the next 5 years on a stock. We would been better off going to buy some food company and make 10% per year on that. So.
Be careful.
Be careful. Good way to wrap that up. Let's talk about the GDP report, because I know a lot of people are going to kind of misread this here. So let's talk about it. While the headline GDP number of a minus 1.4% missed the estimate of 1% growth, the underlying numbers still don't worry me about the start of a recession. If you look at the details, you'll see net exports subtracted 3.2% from the headline number. I believe now a lot of this stems from supply chain constraints and timing in which these goods were received. Remember all those cargo ships waiting off the coast? We talked about that. We said it's not going to go on forever. Well, I don't believe this will weigh as heavily on Q2. Supply chain constraints also brought down inventories as business struggled to rebuild them.
And this is so important because it's not like businesses didn't want to rebuild inventories, they just necessarily couldn't. Right. So if they can get things flowing again, that won't cost GDP. Looking here too, the reason I'm not worried about this whole report is the demand side of the equation. As I said, it still remains strong as the consumer remains healthy. In fact, consumer spending, which accounts for 2/3 of the report, well, that was actually up 2.7%. And don't get me wrong, that's not wow, it's huge.
Right.
It's still a healthy number. And you might be saying, oh, well, that doesn't incorporate inflation. Nope. This report does actually adjust for inflation, and the unadjusted number would have shown a gain in consumer spending of 9.9%. So I've seen that before. People are like, oh, no, you're not. You're not looking at inflation. No, this is real GDP, which does factor in that inflation number. Now, one thing that was interesting is the consumer preference continued to see a shift towards services as it had an outsized gain of 4.3% in the quarter. Private investment also remained strong as it added 1.3% to the headline number as businesses continued to invest on items like capital equipment, and overall investment grew at a 9.2% annual rate. I'm still sticking with my forecast of recession at the end of 2023. I don't think we're going to see a negative report next quarter, which again, all a recession means is 2 consecutive quarters of declining GDP. I don't see that happening because I still think the consumer is going to be okay. And don't get me wrong, this economy, it's not on fire,
right?
But there's still enough liquidity to get us through things. I don't see business investment slowing down, because they're investing heavily, I think, in technology and productivity tools so that they can combat the inflation, they can combat the cost. So I think business investment is still going to be quite high as well.
And there's a lot of money out there. We always talk about the $21 trillion in the economy. Businesses have a lot of money on their balance sheets. Consumers still have a lot of money in their bank accounts. Now, not everyone. I know you can find somebody like, oh, they're really struggling. That's going to happen. But there's, 360 million people in the country. On an average, things look okay, and that's why we say, yeah, there could be a slowdown in the economy, which we're seeing. It's not going to be a bad recession, I don't believe, at this point in 2023, but we could have that in 2023. We always kind of update things, but when you look at this is why I hate people that read the headlines. Well, I saw this in the headline. You've got to read the detail, not just read it, but use your critical thinking to understand, well, what's really going on here? So this is why we're saying, and you hear people, oh, it's terrible, the GDP is negative, oh, economy's doing terrible. Well, no, read the numbers underneath there to find out why it happened. And we talk about, too, there could be an inventory rebuild next quarter, which could actually increase.
And I'm kind of thinking right now, I'm wondering, too, the next quarter.
Right.
With China and their issues right now going on there.
Yeah.
I wonder if that's actually going to be a benefit to the net exports, because if they're not producing as much as they were, we can't import as much from China if things are slowing down there severely. And we receive more than we send to China.
Right.
So if that kind of tampers down that trade a little bit, I'm not going to say that's a healthy number, but it would kind of reverse things as we saw a huge negative impact on net exports this quarter. Well, you kind of might get a little bit of a counting trick, so to speak, with net exports this next quarter if there are issues with China continue.
I would never run for president, but I know President Trump, when he ran, his thing was make America great again. I think I want to run for president and say, make America work again. Because if we were to work, we could get through this. But you got people that just don't want to work very hard. I mean, it's just like, let's come together as a country and work together and forget these exports. I mean, we could do it ourselves, but people just, they want to stay home and, I don't know, play video games. I don't know what the hell's going on.
Yeah, I mean, I'm going to disagree. You can't produce everything. There's still got to be some trade.
Right. but we could do a lot better.
We do a lot better.
A lot better. That's what I'm talking about.
And we are seeing that. We're seeing, again, the big thing with semiconductors. I know that Intel, they're building a lot of fabrication centers right now for the United States and Europe, and they actually said they want half of the semiconductor production to come from the U.S. and Europe and over the next several years. So, right. I mean, we're seeing more of a shift towards what I'm going to call localization rather than globalization, where you kind of produce where you sell.
Right. Well, here's something that unfortunately kind of talks about the problem, and that's a college students starting salary. When I saw this, I just could not believe my eyes. Many college students in the class of 2022 are out of touch with reality when it comes to expectations for a starting salary. According to a recent survey, on average, these students are expecting to earn $103,880 in their first job.
Yeah, little bit off there is the actual estimate for what employers are willing to pay is a little over $50,000, but nowhere near the ridiculous expectations. I mean, some fields are expected to produce higher salaries. Computer sciences now is actually the top field. It seemed like engineering was the top place to be for years, but computer sciences does top the list with a 5.2% growth over last year to a starting salary of about $75,900, and engineering does come in at $73,900. Pulling up the bottom of the list here is the humanities degree with the starting expected salary of $50,700. And it was interesting in the report that was down like 14% compared to the prior year. I'm like, what did humanities do to have such a major decline?
And I know usually people in humanities don't really go, unless they go into teaching. I think they generally go into other fields where they can get a job, maybe in business or something else. So, but it just kind of shows that the silly expectations people have, and why, well, I don't have to work. I can just go to a job and just get $100,000 a year if I go to college. And somebody actually on our social media commented that, well, if they went to a trade school for welding or plumbing or something else, he said they could do that. But I actually remember, I think it's about 3-4 months ago, my segment on KSI, I actually pulled out the average for higher jobs. And even a plumber with experience, I mean, they're still, I think, around 75,000. So you're not going to go to trade school and come out and get 100,000. I mean, that's a big number to get. But again, it shows the unrealistic expectations, which are just in this country not going to happen.
Yeah, and there's going to be, again, some areas it can. Like,
right.
It's just crazy to me that it's 103,000 across the entire country. Like,
right.
I would maybe get it if you were in San Diego and California.
I wouldn't say San Diego. I would say maybe New York City. Maybe San Francisco. I think San Francisco. I don't think even LA. I mean, and again, it depends on. I'm
not saying that it's justified, but I'm just saying I would understand more if the students were in those places, because
right.
everything, I need $100,000 to afford $1.5 million home. Like, I need that, like I'm just saying I think the expectation is more justified. It just blew my mind that that's across the country. Like, if you're in Texas or you're in
right.
Oklahoma, you don't need a starting salary of $104,000, but I can see kind of where people are saying that in California and New York, but it still obviously is not what is going to happen.
Yeah, and what you need and what you want is not always what you're going to get.
Yeah.
Like a reality. So, but I just saw and so far off, not even off by 10%, off by nearly 50%. So
these kids are clearly not doing internships.
That's right. Yeah. So, well, let's lastly, before we take the calls, and by the way, the phone numbers are, wait a minute, I don't have the phone number here. Here it is. I hope this is the right number, 833-288-0973. That number again, 833-288-0973. Phone lines are open. That'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. Before we go to the calls, we want to talk about the situation with Twitter and Elon Musk, and will this go through? What's going on? I mean, it's been big stories. I've been in the news talking about it. You've been in the news talking about it. Just want to kind of bring it up because the question is now, is this really going to go through? And one question I got from somebody like, wow, this is a great time to buy Twitter because when Elon Musk takes it over, the stock's going to go crazy. I told the person, I said, no, it's going to take it private. So it's going to take it private at $54.20. That's going to be the most gain you miss if it goes through.
Yeah. I mean, that's a big thing. I mean, the $54.20, as you said, that's the absolute top there. I don't see. So what could happen sometimes is competing offers to raise the stock. Yep. I don't obviously see that happening. So that's the absolute upside there. And I said this on Fox 5 this past week. I think this is a great offer for Twitter. I think the stock, the company, I think there's no upside. I think it was a bad stock. I mean, $54.20 was a 38% premium to, where they were trading April 1st, kind of before everything started to happen with it. So I think it's a more than fair deal. I think it will likely go through. I don't see many things that could take it down, but I still wouldn't kind of do that. There's a thing that you can do called like arbitrage, right, where you buy it. I think it's still about 13 to 15% away from the current price here, but you have to always look at the downside. And if the deal doesn't go through, the stock, I think, goes down 40%.
Right. And I know that Twitter's now said, yes, we want it, so that's good. We want this deal to happen. The thing that could destroy it, Elon Musk can still change his mind, say, I decided I want to do it. I mean, Tesla stock, because a lot of it's based on that. If Tesla stock were to fall to a certain level, I don't know what that level is, he may be in trouble. And I think he's sold another $8 billion. Yeah. So he's raising the cash. But if we were to see a Tesla go the route of a Amazon for whatever reason, again, they had a great quarter, by the way. Tesla had a great quarter, but still, it is still very, very pricey. And maybe investors start saying, wait a minute, if he's going to spend so much time on Twitter, could that hurt Tesla's earnings going forward? I want to get out now before it drops more. That could be a problem. He might say, no, change my mind, not going to buy Twitter.
Yeah, I do believe he has a $1 billion walkaway fee.
Oh, does he? I was wondering what that fee was.
But actually, that's a lot less than $44 billion. So.
Yeah, a lot less, yeah. And also, too, he could very easily lose that much in his stock because he has a big portion of that stock. So the $1 billion, he might weigh it saying, okay, my stock drops X percent, I'm going to lose $10 billion, or I can walk away from this deal and only lose $1 billion. And I like what he's doing. He wants to have open, for people. I thought it was kind of funny. Don't want to get too much on this, but how some people, well, we're going to quit. I think he says, fine, go ahead and quit. We'll find somebody else.
I really don't think he's doing it to make money. I've said this. I think he's just doing it because he wants to. And Raul from Fox 5, he's like, what did he say? He said, it's like, well, is that a wise financial decision? That's like a fifth of his money. I said, it's a little bit different. If you have like $1 million and you put a fifth of your money into something, that's a little crazy. But Elon Musk has $250 billion. So, you take away $44 billion, you still have over $200 billion. Yes, so it's a little bit different. It's not a wise thing for the average person to put a fifth of something in there. But when you have an absolute dollar that's high, yeah, you can kind of do some things. Because you could lose everything in Twitter. And again, you're still worth over $200 billion, all else equal. I mean, it's a completely different thing. So I don't think he's doing it to make money. I think it's going to be very interesting to see what he does with the company. I did kind of say one thing I wonder about is how are things going to go down in Europe? Because Europe is being quite, I'm going to say, crazy. The UK in particular, they want these social media companies to police, illegal content. Great, get that. Right. But they also want police content that is both legal and harmful. Well, that's a very vague statement.
Yeah,
what does that mean
like
exactly? That's just too open-ended to kind of create, kind of the fact checkers and things like that maybe aren't necessarily right. And the penalties are up to 10% of global sales or jail time for the executives. So I wouldn't be surprised if Elon Musk is like, yeah, you know what? I think we're going to walk away from Europe here.
Yeah, we don't need to be there.
Yeah, it's going to be very interesting to see. I think it's going to be a lot different 2 years from now at Twitter.
Yep, well said. All right, let's go to the phones. 833-288-0973. That's 833-288-0973. Let's go down to Bonita and speak with Milt. Milt, you're on the Smart Investor with Brent Chase. How can we help you?
Good morning, guys. Great to talk with you this morning. I've been wanting to call in on a stock with the ticker symbol MAIN, Maine.
Okay.
It's a real estate investment trust.
And do you hold that or looking to buy it?
Very, very small position, but looking to buy some more.
Okay, well, let's take a look at Main Street Capital. Their symbol, very easy to remember, Maine, M-A-I-N. They are in the asset management industry. Only 2% float there on the short side. Institutional ownership, very low, 18.3. I can't remember the last time I've seen one that low, unless it's a very small market cap, which we'll see pretty soon here. We do see a nice PE ratio of 8.4 versus 10.8. Price to sales 6.6 versus 2.3. That's not good. You do want the valuation ratios lower. Price to book value 1.6 versus 10.3 versus the industry. That is good. And a PEG ratio, very good, 1.8 versus 5.5. Now, they have grown their earnings at a nice pace of 21.5% over the past year. Almost as good as the industry growth at 24.3. Sales for Main Street Capital, well, sales were up 41%, well above the industry at 16.4. They do pay a nice dividend yield of 6.5%. Only use 52% of their earnings to pay that out. That's pretty darn good. And then we do see on the balance sheet, current ratio 0.3 versus 3.1. That shows me non-liquidity. That could be a problem for them paying the bills going forward. And debt to equity is 1. That's the same as the industry. Net profit margin, worsening number here, not because it's the bad, but because it's too high, 78.5% versus 21.9. How can they make 78 cents on every dollar they bring out? They may have had some gain on assets or something in the past, so you want to kind of compare that. Return on equity looking good, 18.5 versus 14.4. and then return on capital is a 10.9 versus the negative 39.3. Jace, what do you got going forward?
Yeah, I was interested in what this company does here, but they're actually an investment firm that actually engages in customized debt and equity financing to kind of lower middle market companies and debt capital to middle market companies. Investment portfolio is typically made to support management buyouts, recapitalizations, growth financing, refinancing, and acquisitions of companies. So it almost seems like they're more of a lender essentially and a financial company rather than like a real estate investment trust there, as you mentioned there, Milt. But looking at the numbers, the current price here for Main Street Capital, that's $40.03. 52-week high here, $47.13, and the low, $37.91. Year-to-date, down about 8.4%. That's not too bad of a decline compared to the market, which is down a little over 13%. Decent-sized business here at about $2.9 billion. It's not a tiny company. It's not a large company. Kind of middle of the road, I would say. Going forward, though, to December 2023, I do see we have estimated earnings per share of $2.98. That would give us a target sell price of $49.47. So I don't believe that's quite at our 30% margin of safety, but it's right around there. Interesting business. I'd have to spend more time looking at exactly kind of their customers, essentially, what they're doing, but also, too, how it impacts the balance sheet, because I think the balance sheet looked a little wonky, but obviously if they have debt, it could be a little different.
And Milt, and I kind of agree with Chase there. I think before you jump more in this company, understand what their product is. It's not like they're selling, chicken or insurance on cars. I mean, it's kind of complicated, and Chase gave a brief summary of what it is, but you really don't understand that, because is that going to do well in a slowing economy? Is it going to do poorly during a slow economy? What are the negatives there? So I would really say spend some time before you jump into it to understand what they're actually doing, because it could go the wrong way against you. And it sounds like if the stock were to go to maybe 38, 39, probably be a buy based on those numbers. Yeah. So I think it might be worth a research, but before you buy any more, I'd really want to have you understand more about the business. All ready?
Okay, great. I appreciate your information. You're always right on the money.
Oh, I like that. I like that. Thank you.
So to speak. Okay, great. Okay, guys, keep up the good work. Everybody loves your show.
Thank you, Milt. We appreciate that. Bye-bye.
You take care. Bye-bye now.
All right, that does open the phone line, 833-288-0973. Let's go out to San Diego and speak with Ken. Ken, you're on the Smart Investor with Brent and Chase. How can we help you?
Hi, guys. Thanks for taking my call. Appreciate it. I've just recently discovered your show, and I'm walking the dog as I listen to your live broadcast here.
Well, cool. But, we'll make the dog a smart investor, too.
That's where I'm hoping to get my advice from later on. I had there's two particular stocks I'd been looking at, one long-term and one short-term, and they were Verizon and Philip Morris because of the environment we're in. Verizon's been beat up. They were trading in a narrow range for a long time, but they've been beat up lately. I just wanted to see what you guys thought.
Yeah, I'm glad you called about Verizon. I've not looked at this company in a while, so I'm kind of excited myself to kind of take a peek at it. So let's take a look at Verizon Communications. Their symbol is VZ. They are in the industry of telecom communications, only 1% short on that, so that's not a problem. Surprised, I thought the institutional ownership would be higher. It's only 65.5, so means about 35 is about individual investors. P ratio pretty good, 9 versus 15.9. That's a good start. Price to sales 1.4, same as the industry. No price to tangible book value because they have a lot of intangible assets, but that's the norm for this industry of the telecom services. Price to cash flow is 5.3, slightly above the industry at 4.7, and a nice PEG ratio of 2.3 versus 6.8. Now, over the past year, they've grown their earnings at 12.5%, while the industry has seen a decline of 19.9. So that's a big positive for Verizon. The sales also looking good over the last year, up 3.7, not a high number, but the industry did experience a decline of 2.7%. The 5-year earnings per share growth estimate from the analyst, 3.7 for Verizon. The industry is at 8.5. They do pay a nice dividend, 5.5%, and use 50% of the earnings to pay that out. Look at the balance sheet. Current ratio, not as good as I would like it to be there. It's 0.8 versus 0.9, and their debt to equity is very high, 2.2 versus 1.9. Now, the positive side is that used to be much higher, but it still does not make me feel comfortable, especially with a lot of intangible assets, the low current ratio. And again, Verizon's a great big company, but they could have problems down the road if things slow down. We do see the net profit margin 15.9 versus 9. Return on equity very good, 25.6 versus 13.9. Chase, what do you got?
Yeah, so current price here for Verizon, well, it's $46.30, 52-week high, $59.85, and wow, pretty much right at the 52-week low. I wonder if they hit that yesterday, $46.17. Year-to-date, down about 9%. Obviously, we know Verizon, huge company, market cap about $194 billion. If we go forward to December 2023, though, I see estimated earnings per share of $5.58 would give us a target sell price of $92.63. I mean, these companies right now, valuations are extremely attractive, I think, in the telecommunications space. I like that aspect of it. You're not getting, again, booming growth. You're getting about year-over-year growth rates here of about 3 to 5%, it appears, for Verizon, but trading at 8 times earnings, that seems pretty reasonable to me as an attractive investment. My only concern is that high debt to equity.
Yeah, and that's why I kind of like the company, and I actually use Verizon myself. I've been with them since 1990, I think it was, when we first had cell phones. And the competition does kind of worry me a little bit on this as well, because it's really become, I don't say commoditized, but it's just really very difficult. You've got that weak balance sheet. I want to say, yes, this is a good buy, but I would be worried about the balance sheet if I held this company. So that's where we stand on it, Ken. I'd be a little bit careful of it.
Okay, that's good to know, because as I said, I knew they had high debt. I just didn't know how that played into future earnings. I guess you guys displayed a mixed bag of good and bad. So
Yep.
I guess you would be on neutral. What about Philip Morris? That's more of a cash cow type thing, I think.
Well, we got a lot of holders behind you, so we can't do Philip Morris.
Okay.
But one thing I was going to say, too, on Verizon is what you may want to do is read or listen to the conference call on the quarterly earnings to see what they're saying about the debt. Are they addressing it? Also, to look at the balance sheet. Is the debt increasing or decreasing? What is their plan? Because if they're decreasing that debt, I'd feel a little bit better. If it's rising, I'd probably would stay away from it.
They've had to build out a lot for 5G as well, so it could have had a heavy investment cycle already, and that could be kind of tapering off here, which could leave room to pay off debt. So, again, not saying it's A-OK, but could be some potential there, I'd say.
Yeah. All righty?
Okay. Well, thanks, guys. Have a great weekend. I appreciate your time.
Okay, hope the dog's smarter now.
Absolutely.
All right. Have a good one, Ken. Bye-bye. All right. That does open the phone line, 833-288-0973. That's 833-288-0973. Let's go out to Oceanside and speak with Don. Don, you're on the Smart Invest Show, Brent Chase. How can we help you?
Yes, hi. You opened the program talking about Apple and the issues that you guys have seen for the long term. I own a fair amount of Apple. I can't remember exactly how many shares, but what do people do like me who want to get out of it, but are going to get hit with huge capital gains taxes if they just dump it?
I mean, that's a great question, and sometimes you have to unfortunately pay the tax man. I'm assuming this is long-term capital gains, so you'll pay probably about 20%.
Right.
Do you have a good tax person that you work with?
Yeah, I guess so.
Yeah, because what you want to be careful of, I mean, you don't want to put yourself into the high tax brackets by selling too much. You want to have a balance here because, again, you don't want to dump everything right away if it's going to cause you major tax problems. Because, again, I don't see Apple being cut in half. I suppose it's a possibility. But you want to have a plan of saying, okay, let me kind of unload Apple over the next maybe 2-3 years. And this depends on how much you have, what the taxes are going to be. Again, and the problem, too, in the state of California, I assume you're in California. Yeah, you're in Oceanside. I mean, the state of California does not have capital gains tax. So it could put you in the 13.3% tax bracket on top of the 20% there. So you want to try to have an exit strategy. But if you have a big portion of this in your portfolio, I have a hard time saying dump everything.
Yeah, and the other thing, too, is, I mean, you're looking at the high end at 20%. I mean, sometimes, depending on your income, it could be 0 or 15%. So you got to look at kind of the numbers for your situation. I know in the past we have had clients where we've been able to kind of work with it to pay very, very little tax. But the other thing that I look at is on companies like this, yeah, it sucks to pay 20% tax, I'll say at the higher end. But it doesn't necessarily mean your break even is a 20% decline in the stock, because the 20% tax is on the gain of the company. So maybe the break even's a 10-12% loss, which very well could be a possibility with Apple. So I think it would need to be some type of a targeted plan for you there to kind of reduce those holdings maybe over the next year, 2 years, 3 years. But I definitely think reducing the holdings is not a bad decision, and especially it's a comparative as well. I think there's a lot of companies that will outperform Apple. So, yeah, maybe you pay the tax on it, but you buy something else and you do better in terms of your overall portfolio growth.
Yeah, what you can do, and that we do when we look at situations for clients, like, okay, so if you pay the tax there, and I'm just throwing out numbers, they're not real numbers, the stock's at 160, because as Chase said, it's not, you don't pay tax on the full amount because you have the cost basis. So my break even on the tax versus stock would be if the stock fell below 140, then I was better off paying the tax than holding onto the stock. So you want to kind of know that number as well, because then that makes you feel better, because again, you're not going to pay tax on the whole amount, but what is the break even tax versus the loss in the stock? So look at that and then make the decision. All righty?
I think a gradual reduction over a period of time is probably the best way to look at this.
Yeah.
Yep.
So,
Yep. And
you're right. Thank you.
You're welcome. Thanks for calling there, Don.
Right.
Bye-bye.
Bye.
I just got to say, I'm shocked here. I haven't looked at Apple's fundamentals here in a while. I mean, I looked at their future earnings the other day. Obviously, that's how I knew the 25 times. But their dividend yield now is 0.6%.
Ooh, wow.
And I know they just increased it, but I did not enough, I think, even to get over 1%. So that's just another way to look at this company. It's very, very expensive. Not that the dividend yield always tells you the valuation of a company, but 0.6%, you're not getting much on that.
I remember back when we held it, I think we were getting like a 2, maybe 2.5% dividend. So they've not kept pace with the increase in the yield. Unfortunately, the dividend payout ratio, well, it's 14.2. They do buy back a lot of stock, but it's been kind of nice, because then if the stock falls back, gosh, you get a great yield. But now if the stock falls back, we'll say to 125, 130, might be about a 1% dividend. So not attractive for value investors there yet either.
Yeah, and I think they're buying back $90 billion worth of stock.
Yeah.
Still, again, doesn't really move the needle when you're, a $2.5 trillion company. And also, too, I wouldn't be buying back stock at over 25 times earnings.
Yeah. Well, and that's why maybe this would be a better time to increase the dividend as opposed to buy back stock at such an expensive price. And I cannot count the number of companies over my 40 years of doing this where I see them buying back stock at these outrageous levels. Like, why are you guys doing that? To just bump the stock price? It's not a good long-term thing, because then, 10 years later, you've got stock that you paid for that's still not back at that price. Yeah. So buying stock at high prices, we like buying back stock, but not at high prices. Just makes no sense. All right, I want to go to Richard because he wants to talk about Google, but we're going to have Richard, if you can hold with us for a few minutes here. I do want to talk to our financial planner, Harrison Johnson. He's our CFP at Wilson Asset Management. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well.
Well, I always know what you're talking about. I have no idea what the Augusta rule is, so I'm very excited to hear this. What do you got here for us?
So the Augusta rule, it is after IRS Section 280A, and basically what that IRS section code says is if you're a homeowner, you can rent out a home for up to 14 days per year, and you don't have to report that income, or you don't have to report that rent. So it's basically tax-free for up to 14 days. It's called the Augusta rule because it's named after Augusta, Georgia, which is where the Masters golf tournament is. And so it's a large golf tournament. When it's going on, a lot of people travel into Augusta to watch the tournament. And so residents rent out their homes to people who are staying in town. So that's kind of where it came from. But as far as how we can use this now, if you are a business owner, so if you have an S Corp or a C Corp or a partnership, basically anything other than a sole proprietorship, what this means is you can rent out your home for business purposes, and that way it's a business expense. But if you do it for 14 days or less, you don't have to pick up that income you're paying to your personal side and actually pay taxes on it. So basically what you can do here is you can kind of shift some of your profit that would be taxable on the business side to your personal side, and then that way it's tax-free. So it's kind of like a non-cash expense because you still get the write-off, but you're not actually parting with any cash. It's just going from the business to the personal side. So what this might mean is, if you have a monthly board meeting or client appreciation meetings or employee appreciation meetings or whatever, as long as you can say that this is a business purpose, you can rent out your house at the fair market value and kind of get yourself some tax savings there. So, for example, if you rent out your house to your business for $500 a night and you do that for 14 nights throughout the year, that's a $7,000 expense that isn't really expense because you're paying yourself, so to speak, but you're still getting tax benefit for it.
And here, so I'm thinking, how can we use this as a suggestion for people? What I'm thinking is like, okay, you got a 2-week vacation planned in Maui in August, the first 2 weeks of August. So what you do is go on your vacation and rent out your house for that 2 weeks, get tax-free money for the rent on your house to help pay for your vacation. Could you do that?
Well, you could do that as well, as long as you're a homeowner. But, there's some people that aren't necessarily comfortable with renting out their personal house. So it's more common for business owners to do it. It's like, okay, well, once a month on the 5th of every month, we're going to have a meeting at my house instead of the business. And that way we're renting out the house for the business use of that. And so then you get an invoice on the business side, which is an expense, and then your business pays yourself, your personal side. So it's tax-free money, basically. It's kind of like depreciation, a non-cash expense.
So you're looking more from the business owner side, that's what a business owner could do, in addition to the idea I have, which I know I would not want to rent my house to somebody, but some people do. They do the B&Bs and stuff. Airbnb. But this is another angle that people can do. And again, this is what a financial planner does. It comes up with different ideas rather than say, oh, we'll buy ABC fund.
Do you know the answer to this, Harrison? Is there how do you determine the value of that? Obviously, you can't be like, oh, my house is worth $5,000 a night.
One way you could look at doing it is go on like Airbnb and see what similar houses are being rented out for, and that's probably a good way of kind of coming up with a number. Yeah, you can't say, well, you have $20,000 a night or something, but if there's houses around that have similar square footage and similar bed and bath and sizes, and they're going for $500 a night, then that's probably something that you can reasonably use. So like for Brent, for you, I know you don't have a house right now, but you'll probably buy a house at some point. So that means if we start doing meetings at your house once a month, then you can treat that as a business expense, deduct it on your taxes, and then not have to pay it on the personal side. So it just reduces tax liability.
And just to let people know, I'm not homeless. I don't live on the street. I do rent a home. But you can't do it for a rental, though, can you?
No, you have to be a homeowner, and according to the IRS Section 280A.
All right. So if I get a good deal on the home, and my plan was like a 5-year plan, that I think there'll be a great time to buy a home over that 5-year period, then I would maybe do that. But I gotta tell people I love renting. It just has really made my life so much easier. I don't worry about fixing things. I don't worry about the pool maintenance. I don't worry about the landscape. Sometimes I wonder if I'll ever buy a house again. I think I will if I get a good deal, but I'll never overpay. So.
All righty. Well.
I guess I left everyone speechless there. Well, Harrison, thank you very much for calling in. We'll see you on Monday, and you have a great Saturday there.
Thanks, guys. We'll see you Monday.
Okay, bye-bye. All right, that is Harrison Johnson. Again, he is our CFP, our financial planner at Wilsey Asset Management. If you want to have a free consultation with him, talk about your situation, again, he covers the estate taxes, he covers the taxes, planning, all these important things to really get your financial life in order. You can give him a call at the office, 858-546-4306. That's 858-546-4306. Or you can visit him on the website. Just go to our website, smartinvesting2000.com. That's smartinvesting2000.com. All right, the phone number is here. You want to get through for that unbiased, no strings attached, firm opinion about what you want to talk about. The number here is 833-288-0973. That's 833-288-0973. As promised, let's go out to San Diego and speak with Richard. Richard, you're on the Smart Invest Show. Brent and Chase, how can we help you out?
Hey guys, thanks for taking my call. Taking a look at Google here, and I see a price to earnings growth below 1. And I take a look at their profit margins and everything. It looks pretty attractive to me here. Just wanted to get your guys' opinion.
Sure, let's go over all the numbers for Google. I'm glad you called in about this because I was kind of curious myself with a pullback. Where do we stand now on Google or Alphabet? Their symbol is GOOGL. We do see they're in the internet content and information business. Float very low still, 0.7%. Institutional ownership, highs expected, 80.1. We do see a PE ratio now of 20.7. That still is above the industry at 17.5. Price to sales, 5.7 versus 5.1. Price to tangible book value, 6.5. That is more expensive than the industry of 4.8. And price to cash flow looks okay, 14.8 versus 16.7. Now, they do have a PEG ratio of 1.2, about the same as the industry at 1.1, but 1.2 is a very good PEG ratio. Their earnings over the last year, well, they are up 47.3%. That sounds very good, but the industry is up 81.9%, so I'm kind of surprised that Google is less than that. Sales for Google up 37.4, also a good number, but the industry was up 51.4. The 5-year estimated growth rate from the analysts they give on the earnings is 17.1, above the industry at 13.3. I thought Google paid a dividend. I guess they do not. I must have been confused. They do not pay a dividend. The balance sheet, current ratio, very positive, 2.9 versus 2.8. Debt to equity, very good, 0.1 versus 0.2. Net profit margin checks in at 27.6, slightly above the industry at 27.4. And return on equity, 29.4. That is exactly the same as what the industry return on equity is. Chase?
It is interesting to Google, Alphabet, whatever you want to call it there.
We're going to call them Google.
Google, yeah, they have still the voting shares and non-voting shares.
Yeah.
I'm always still kind of surprised by that. They're one of the only major companies, I would say, and one of the big tech companies. And there's super voting shares and stuff with other businesses like Facebook, Meta, but I'm still surprised that they have that. So I don't know if you want to look at that closer. If the voting and non-voting shares are trading in parity, the same kind of valuations, you always want to kind of buy the voting shares, in my opinion. So just make sure you know what you're buying there between GOOGL and GOOG. I believe the GOOGL actually has the voting rights.
Yeah.
But looking at the numbers here for Google, current price for, I'm going to look at GOOGL, $2,282.19. Look at this 52-week high here now, $3,030.93.
Wow. And
that high did occur on February 2nd of this year, so it did occur in 2022. 52-week low, though, for the business, $2,193.62. See that year-to-date return down now 21.2%. Obviously, this company's still done tremendously over the last 10 years, up 641.5%, so it's still seeing great growth. I think a great business here. Very curious to see what's going on going forward. Looking at those numbers for December 2023, I see estimated earnings per share of $133.76. That would give us a target sell price of $2,220.42. So not quite at that level yet. I'm very intrigued if there is still going to be that volatility. This is kind of one in particular that I'd be interested in scooping up if the prices were right. And especially, I talked about Apple's slow growth.
Right.
It looks like Google, Alphabet, they still have pretty darn good growth. I mean, this year they're looking for sales growth around 16%. Next year, about 15.5%. The following year, around 13.7%. So you're still in that double-digit range. I mean, that if you could get this business at around 13 times future earnings and you can get that type of growth, that's an awesome opportunity, I think.
Did you say they hit 3,030 February this year?
Yeah.
Do you know if that's, we probably don't know, but we can check into it, if that's when they announced, because I think they're doing a 20-for-1 stock split.
Yeah.
And I wonder if that's about the time frame. And I'll be talking about stock splits tomorrow in my segment on KSI around 8:40, because this is why people go, oh yeah, it's going to split the stock. Well, if that is the case, that's a fall of well over 20%. So, again, I'll talk more on KSI tomorrow about it, but I always tell people, be careful of stock splits.
They announced it in April.
In April. Okay, so
oh, wait, no. I get conflicting date here. I see one now that's February 1st. It looks like the first article. February 1st, Alphabet announced its 20-for-1 stock split on CNBC.
And actually, Richard, we like the company. I think it's a great company. I would love to own this company, but I think it's worthwhile to be patient to try to get it at a good price. And I'm hoping there's more to fall so we can pick up a company like this. But right now, I can't recommend buy for it. All righty?
Yeah, appreciate that. Thanks.
Okay, Richard. Thanks for calling. Have a good one. Bye-bye. Chase, I was thinking one thing here, too, before we go to the callers. I like the old school. I don't want to call Alphabet Google. I don't want to call Facebook Meta. I don't want to go to Starbucks. I want to ask for a small, medium, or large.
I did that the other day.
Yeah, because you go in and I say, can I have a large? They accept it.
No, I asked, what's a medium? He's like, well, most of the time people think of mediums like a grande. And I was like, okay.
Yeah. And we don't go to Starbucks all the time, but it's just like, I've done it, I think, twice now. And I just walked in and I said, can I get a medium? And they just give me, I think, a medium. It could be a large, I don't know. But it's like, I don't want to play these word games on stuff. And like, why did Facebook, I don't know why they're changing the names, but just like, you stay with that good name. And I do not, I've been doing this for 40 years. I do not remember companies changing their names at the pace that it seems to be happening now with some of these companies.
I don't know. And that is one thing I would say with Google, though. While I think it could be an intriguing business if the numbers are right, there's so many other things with Google that you got to look into. Like they have the Waymo, they have all these other kind of divisions of the business outside of just advertising. So you got to spend a lot of time understanding this company because there's a lot to the company like this.
All right, got to get back to the phones here. Got a lot of callers there. Let's see. Let's go out to San Diego and speak with Anthony. Anthony, you're on the Smart Investor, Brent Chase. How can we help you out?
Hi, thanks for taking my call. I was looking at VSAT and noticed it went down 25% in the past month, so I'm wondering what you guys think of.
Okay, and do you hold that, or are you looking to buy it?
Oh, I don't. I'm just looking to buy it.
Okay, yeah, and VSAT's a company I've known for years, and I thought that was a very interesting company, but they got kind of pricey, so maybe now will be a good time to get into the company. Company again is Viasat, symbol is VSAT. They are in the industry of communication equipment. Kind of a high on the float here on the short, 8.6%. Institutional ownership, 84.5. The PE ratio still very expensive. It's over 100 versus 17.8 for the industry. Price to sales 1 versus 1.9. That's positive. Along with price to tangible book value is 1.4, nothing for the industry. And then price to cash flow 4.9 versus 11.6, but not a good PEG ratio. And I usually don't see this. A PEG ratio against your PE divided by growth tells you how much you're paying for the future growth. For Viasat, it's 12 versus 3.4. That is not a good indication of what you're paying for the future growth. We do see over the last year, earnings did climb by 400% versus 29.9. I think that's something to do with accounting. I don't believe they grew their real earnings by 400%. Sales over the last year are up 18.9% versus 7.6%. They do not pay a dividend. Taking a look at the balance sheet, current ratio 1.3 versus 1.7. I'm okay with that. Okay with a debt to equity 1, same as the industry. Net profit margin, not so good here, 0.8% versus 10.8. And return on equity, same number, 0.8 versus 28. So I'm not too thrilled with what I'm seeing here. Chase, what's the earnings like going forward?
Yeah, I was kind of interested in a couple different numbers here as well. And one thing is the numbers are all over the place for their income. I mean, you talk about that growth. Their net income last year was $21 million, it appears to be. The year before that, in 2020, negative $2 million. 2019, $1 million. 2018, negative $90 million. So their earnings are just so variable, which is always kind of hard to evaluate a business like that. That's a concern I would have if I bought a business. All of a sudden, it's like, oh, things are great. The PE looks great. And then all of a sudden, oh, they have a negative $90 million income the following year. Yep. And I think it's because that they have like satellite launches and stuff. So they have these big ramp ups in terms of producing this stuff, but just something you got to be cautious of. Look at the numbers here, though. Current price for Viasat, $36.81. 52-week high, $68.76. So taking a major hit there. 52-week low, $36.20. Year-to-date return down 17.4%. And I'm shocked by this. 5-year return down 42.5%. 10-year return, a negative 23.4%. Viasat has not been a good place to put your money for the last decade. Decent-sized business here, though, $2.7 billion. Now, if I go forward to March 2023, so the report on a fiscal year here, I see estimated earnings per share of $1.45. That would give us a target sell price of $24.07. I can't wrap my arm around these numbers here. I don't think I could recommend a buy on VSAT even at these levels.
Yeah, I'm kind of disappointed. I was expecting better things, but maybe, Elon Musk and Virgin Atlantic, whatever these companies are, maybe they're giving them problems because now they're doing satellites. I don't know, but the earnings are not very good. They got competition now, it appears to be, in this industry, so not good numbers. So I would unfortunately say no, it's a sell, not a buy.
And I see a couple other issues here too. I mean, they have high stock-based compensation.
Ooh.
They also have a high share dilution. So they have a lot of different convertible securities out there that could be converted to shares down the road, which would impact current shareholders even more. So there's a lot of accounting things on VSAT that I'd be very cautious on as well.
Yeah, I believe it's a San Diego-based company, so
I believe so.
yeah. Sorry to say, Anthony, we're going to say this is a sell. I would not even look at buying this company. All righty.
All right, great. Thanks for looking at it.
All right, have a good one. Bye bye.
Yeah, Carlsbad, California.
Yep, Carlsbad. Oh, and he's in Carlsbad. I think he was from. Was he? No, he's from San Diego.
Yeah.
Yeah. We. I'm looking at. Gosh, I'm kind of babbling. I think we come off air. What? 3 minutes. Yeah, I don't think we should take another call. What do you think? I don't know.
Yeah, let's maybe just do an email since we can roll through that really quickly.
Yeah, let's do that. We've got this request. I got to do this one. We've got this request on Dole for like 3-4 times. I said, well, send me an email so I won't forget. I remembered, so let's go ahead and do Dole, which is I call them the pineapple maker.
See if it's a sweet deal.
Oh, that was a good one. All right, so let's pull up the numbers here on Dole. This comes out of, again, it was on I think it came through Wilson Asset Management social media. And so I always tell people, well, email me, because it's much easier than try to remember for the show. But we got it here. Here's Dole. They're in the farm products industry. Their symbol is DOLE, same as the company. 2% shares float on the short side. Institutional ownership, 42%. No PE ratio. Tells me no earnings will last 12 months versus 14.4. Price to sales, 0.1 versus 0.6. Price to book value, 5.6 versus 13.3. Price to cash flow, very expensive, 52.4 versus 19. Good peg ratio, though, 1.2 versus 7.1. Now, I see no earnings for the past year, 5 years, no sales. I'm wondering, they just report earnings? Maybe it doesn't look like it. Next report date is May 24th, so I don't know why we have nothing here on earnings or sales. They do pay a 2.7% dividend. No payout ratio, because we don't seem to have those numbers, like we're missing some data here. Current ratio, 1.2 versus 2.1. That's okay. Debt to equity, high, 1.6 versus 0.7. I don't like above 1.2. And then net profit margin, negative 0.1 versus 4.3. Return on equity, a negative 7 versus 14.17. I don't like what I'm seeing. Can you change my mind here, Chase?
Current price for Dole, $11.91. 52-week high, $17.66. The low, $11.56. The reason there's not many numbers, they IPO'd last year, so there's not even a one-year return just yet. So that's why the numbers look a little strange. But year-to-date, they're down 10%. Now, I'll tell you, going forward, December 2023, estimated earnings per share, $1.63. That's a positive. Gives us a target sell price at $27.06. I mean, the valuation looks very strong on this business. A little concerned about the debt. I also am quite cautious of companies that don't have that full year data just yet. That's always a turnoff to me, because there's so many other companies you can buy with better data, I would say.
And I'm not sure, but I think this was public, went private, and now it's come back out again. So
I do wonder. I'm not a pineapple farmer, so I don't know how you grow pineapples, but I know that a lot of the farm products are so expensive right now. I'm wondering how that's impacting their business. Maybe you don't use manure and stuff like that, but it's something to know about if you did decide to invest in this company, is how do you farm pineapples?
And I think it's not just pineapples. I think it's also bananas and stuff as well.
I think you're
and
right,
you always see down on the bay, you always see that Dole ship there, and it never seems to move. It just seems to sit there the whole time. Maybe it moved during the week. I don't know.
Yeah, I mean, I like the business concept. Obviously, we like food companies like this. But I wouldn't be ready yet. Maybe a couple quarters from now, once we have full year data. But kind of see too if they're paying down debt. If they're paying down debt, that could be a great business. It's a business that we like to own. But we'll see what happens with Dole.
Yeah, I like the company. Don't like the numbers.
Yep.
Well, there's the closing bell. Thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. Or visit our website, smartinvesting2000.com. That's smartinvesting2000.com. And for more daily educational information and investment tips, go to our Facebook page, Smart Investing with Brent and Chase Wilsey. Have a great day. We'll talk more next week right here on the Smart Investing Show.
So amusing to think that I did all that, and may I say